Final hour just after 3 p.m. on July 1st. Happy July. Kicking off a new quarter, new month. So let's get after it. Thumbnail today, simple math income trading. I'm going to be on a session tomorrow at 11 a.m. Eastern time called the Profit Panel. I think it's going to be Kane Shea and Alex Reed and myself, and looking forward to collaborate with those fellers. But I just want to show, I basically I did this in my Telegram today, updated some of the core positions that I have, just doing some basic math on some of these campaign trades that I've been generating income on. So I wanted to review that. Here is a look. I posted this in my Telegram today. So just had some trading time as I always do. Try to carve out a couple hours a day where I'm just pruning the portfolio A to Z. Actually ended up having 3 winners on the day for daily profit play. Campaign trades include trades on Intel, Snapchat, JD, TLT, IWM, and Tesla. Collectively, this is what I want to talk about. Just using option strategies to track your overall cost basis. If you are adding hedges, does it increase your cost basis? If you're selling premium and you're taking profits on those, you decreasing cost basis. Selling covered calls, something very basic. Decreasing cost basis, increasing profit potential. Some of these trades are in the money. Like my Intel trade is in the money. My JD trade is just out of the money. My TLT trade is just out of the money. My IWM is in the money. My Tesla is in the money. Nevertheless, I'm still generating income. So for example, I increased my profit potential on Tesla by $710 on the shares that I have. I have, I want to say 600 shares of Tesla, and increasing. That's a pretty good chunk. If I let it get called away, $7.10 at 600 shares, I'm increasing my profit potential today by going out just a couple more weeks with a rolled covered call by $4,200. So $4,260 in the next 3 weeks on Tesla. Price has to stay above 260. We're trading at 300 and change. Russell, I rolled my calls up and out. I got $1.05. And so with the increase in my strike from $200 to $201, I got $1.05 plus $1, which is $2.05. I have over 1,100 shares of Russell. So today, just with a couple weeks out to that 8/1 expiration, I've increased my profit potential on the Russell by $2,255. Okay, TLT, I'm still working a diagonal spread, so I bought a 65 call and I'm selling against it. That's just above my debit price. My cost basis now is $19. A 65 plus 19 is $84, and I'm letting it called away by 89, which means $5. I've got 3,200 shares of TLT. $16,000 would be my total profit if I get TLT called away at $89. Okay, JD, I've got 1,500 shares, increased my profit by 44 cents with a roll. So just like that, $660 to my bottom line on JD, and I get the upside appreciation with the shares that I own in the low 30s. So net on JD. Let me see what the math is here. And I want to start from scratch. Let's go into the charts today. I'll take an example. You want to buy shares of blah. Maybe it's Robinhood. Maybe it's Palantir. Maybe it's Oklo. Maybe it's cores, whatever, like whatever's hot in your inbox or whatever you want to chase, which I don't like to do. But I'm saying, like, there's ways to establish a core position and talk through the math, because it's not that hard. It's old school. Like, I track all my stuff on a just simple spreadsheet, and I just control F and find it, and I just add it in and update my spreadsheet every day that I'm placing trades and every week, right? So it's not the most glamorous. I don't have AI tracking my trades for me. I do it old school, but it certainly helps do some very basic math and know, like, hey, if this stock gets called away, I know exactly what I'm making on it, right? I know exactly where my break even is. I can set my chart alarms and plan accordingly, so I can either, one, embrace the fact that I can generate income on these trades. Two, I can just spend time lowering my cost basis consistently. Three, I can get out of the way and let price appreciate like crazy. Sometimes that's easier said than done. We always want to let the prices run. We want to let our winners run, but sometimes prices go nowhere. Sometimes prices go down. Sometimes prices rip like crazy, and you can't stay ahead of it. So, you roll with the punches and you make the best of it. So does that make sense? That's what I want to kind of talk about today. I'm going to share more of this tomorrow in my session with the profit panel. But point is here, do we find ways to lower our cost basis? And in turn, do we increase our profit potential? All right. So if we go into the numbers. By the way, today, how many daily Profit Play members do I have that are watching for today's final hour session? We took a trade this morning, and this morning's trade, we were in here, had a broken wing put fly, closed out for winners in the morning around like 10:30 to 10:45. We had a winner there. I also put on down here. I put in another put fly, and I put in another put fly. So I had one winner in the morning, one winner in the morning, one winner late morning, and one winner just now. So actually 4 for 4 today on daily Profit Play. A little bit more aggressive than I probably cared to be. I wasn't super stoked about this 6,200 pin price that I had on a broken wing, but this little 5 to 10 minutes we've had just now, like this breakdown right around 2:55 p.m. Certainly helped out. I had a 6,200 pin price, now at 61.96. Was able to close that down for about a 50+% winner. And probably, I mean, honestly, if I didn't touch it, it's probably down. Let me see what the price is at right now. So 45 is now trading for 30. 30 to 40 cents, 15 cents, 20 cents. I mean, maybe grabbing more profit, but I didn't. Whatever, it's fine. I closed out for a winner. So I'm taking 4 for 4 on the day. I'm happy with that. All right. So let's talk a stock this morning. What stock has anyone been watching? Are there any stocks out there you'd like to own? Let's kind of walk our way through it. I don't care what stock it is. Just don't make it like an inverse ETF or something like that's not something you want to own and actually work through. I think right now something that's kind of interesting is Intel because it's cheap enough. There's some good upside potential. Doing some simple math on this, the call premiums are relatively decent. That's why I was able to roll this today. My break even on Intel is now, let me go to Intel. My break even is $19.59. Okay, $19.59, and I rolled my calls up to 23. So if I get it called away, 19.59 minus 23, I make 341. I'm in 1,500 shares. So if I let this get called away at $23 in the next week or two, I'm making over $5,000 on Intel. I bought this thing right around 20 bucks. I've been using covered calls the entire time just to lower the cost basis. Not that hard. Okay. So if you got a stock you want me to take a look at, that's great. I can take a look at Intel. It's cheap enough. I don't think it's going to make anyone flinch. We're like, oh man, $2,300. Okay, well, we can talk about owning shares of this. A stock like Snapchat is also pretty cheap. That's ripping pretty nicely. I own shares of this one around $8.10. Right now it's up about $1.30. I'm trying to let Snap run up into this resistance around the $10 or the $12 levels. This alert needs to be changed to $12.90. So that message should be $12.90 quick profit level and then limit hit. So I've got to take profit on my shares at $12.90. So there could be a nice little squeeze here towards like the 12.50 to 12.90 area. Chart alarm is set. Let me go down here to 12.50. And the premiums are decent. Okay. Something that came up yesterday in session, CORZ. This has been pretty hot. This is a Bitcoin mining company, I believe. And we're talking, a big rip since the lows around 650. This thing is up around 178%. This is engages in business operating purpose-built facility, digital asset mining, provision of blockchain. It's just Bitcoin mining. So going from like $3 up to 17 is pretty darn good. A mining company that I've been in for a while is BITO. It's not going anywhere. It's not at all trading like the spot price of Bitcoin. That's okay. There's still like a ridiculous yield. I mean, in a way, this is kind of like a yield max position where I'm getting 55, almost 56% yield. However, the stock price from these recent highs is down about 40%. So the return on this, I mean, if you think about this, from high to low, this thing's down about 40%, but the yield is 55%. So you're still netting something. And so, I mean, roughly speaking, if this is down 40%, but I'm yielding 55, I'm still making like 15, 16% return on this position by just holding. I don't love the structure of this trade. In fact, I'm looking for something that would give this a run to the upside because I really just want to dump it. I don't mind like getting rid of this thing at 28 or $32. My cost basis on this is pretty low. I own this thing in the teens, but I'm just also sick of watching this thing bleed lower, when in turn, I'm watching the spot price of Bitcoin. Maybe this offers some pullbacks like so, and then we have some consolidation, and then Bitcoin can actually take off and get some new highs, maybe. So this as a spot price, I mean, if Bitcoin appreciates in value, I'd rather trade, an IBIT and FBTC, some of those approved ETFs, to get some of that exposure in the stock portfolio, trading a core position, selling options around it, hedging to the downside for protection, letting price run to the upside. Okay. So let's use an example. All right, let's talk. Like I said, this is the thumbnail for the day. Simple math income trading. I'm going to talk Intel and just share that as an example because the price is pretty good. I mean, I look at the fundamentals. I look at the fundamentals on Intel. I think there's room to get into the 30s or 40s. So here's Intel. Snowflake is decent, doesn't have a lot of risks, which is nice. It's trading way below estimated value. Earnings are forecast to grow. Good price to earnings, price to book ratios. 1.8 price to sales is pretty cheap, right? Current price is 22 and change. Fair value is almost double. I like that with potential upside. We're also talking, chips. It's a competitor to NVIDIA. It's not NVIDIA. Obviously, it's not NVIDIA. But if it is playing catch up and it's dirt cheap, maybe this one is better. Look at Micron's 4.1. This is 1.8. Marvell's 10.3. Texas. I mean, I don't know why. Whatever. Chips, analog devices, but 1.8 price to sales. Okay. Is it a guaranteed moneymaker? I don't know. It could just be choppy. But if you look at where these levels have been, okay, we're talking bear market 2022 lows. We're below that. So more consolidation. This is kind of what I'm trading right now. Is if we have some consolidation, we have lows around, what is this, around $18? Lows around $18 and recent highs around $25 to $26. I mean, if you think about that as a range trade, I mean, obviously it'd be nice to see this thing go all the way up here another 170% and it rips up to $50 a share. But realistically, if it takes time to build a bottom here and it's going to be, this structure down, consolidate, 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 and then we start to go, well, there's two ways that you make a lot of money in this window. One is you just keep flipping this thing from lows to highs, lows to highs, lows to highs, lows to highs. Anytime this thing comes back to hit $18, you buy some shares and then you dump it at 25, $26 if it finds the range highs. The other side of it is you just buy it and you sell calls against it and you try to lower your cost basis below 17, below 16, below 15, below 14, below 13. And eventually, if this thing does end up ripping, you stay out of the way and all of a sudden we run up to $50 and you've lowered your cost basis by $5, $6, $7, adding to that bottom line. So the way you can just think about the visuals of owning a share is if you bought something. So let's say you buy shares like this. So I buy shares. Okay. So I'll just say right now, I'm going to buy Intel at 22.91. Okay. So example. Okay. Not financial advice, educational purposes here. We're going to do some simple math. So if I buy the shares at 22.91, I'm going to say I've got a profit target, near-term profit target at $26. Okay. So what does that make me? If reached, I make $3.09 per share, right? So if I buy shares right now and I spend, roughly $2,300. So if we have 100 shares, costs $22.91, right? So I can make $309 per share, which return on that would be if I made 309. So 309 divided by 22.91 is about a 13.4% return. So that's a 13.4% return on capital or risk. Because the most I could risk is if this thing goes to zero, I'm risking $22.91. Probability going to zero, very slim. But if I hit $3.09 per share, hit my $26 profit target, let's say that's my limit order to sell and get out of the trade, I'm making 13.4%. Now, what I'm going to look at on Intel is I'm going to look at selling every 30 days a covered call. And if I want there to be some price appreciation, what I'm going to try to do is sell like a 30 delta or a 20 delta call and see what type of premium I can get for it. Because I can roughly ballpark if I go out 30 days, 30 days, 30 days, 30 days, 30 days, if price doesn't just rip to the upside, let's say that we just kind of chop around between like $22, $23, $22, $23, and I can stay out of the way. What you're going to notice is we're going to take our share price at $22.90 and decrease it every 30 days by a little sliver of that covered call, or the whole thing if it's not called away. Okay, so if I'll save this chart here, and I'm going to go into the options chain. Let's go to Intel. So if I were to buy shares right now of Intel at 22.92, I'm going to go out 30 days, which is August 1st. Okay, earnings on this, by the way, August 7th. So we can get some premium before we have an earnings catalyst. And I can go out. The deltas are pretty decent. I mean, honestly, I get myself some upside appreciation, and I could do like a 25 delta, make 50 cents. Okay, now this is kind of nice. I hit my $26 profit target, but if I sell a call at the $26 level and I do that now out for 31 days, I'm still going to get 50 cents in that covered call. So this is what I'd like to do. This is kind of the simple math I'm talking about. So here is using options for income and lowering cost basis. So I buy 100 shares at $22.91. I sell a 30-day expiration call at $26 strike. Okay, for 50 cents credit. Now my break-even price is 22.41, and price is still called away at $26 if Intel is greater than 26 by expiration. Right? So what happens with that? What happens with that? If called away, I now make $3.59 per share. Right? I just pulled in an extra 50 cents. So that's an extra $50 per share. Okay? Well, I should say an extra 50 cents per share, but it's an extra $50 of profit. So again, rather than making 309, I make 359. The nice part is I can continue to do this. And again, this is a little bit more hypothetical here, but if I just go like every 30 days, I try to generate at least 50 cents credit, at least 50 cents credit, at least 50 cents credit. Sometimes it's at the money, sometimes it's out of the money, sometimes it's in the money. If I try to generate 50 cents credit, let's just say I do this for the next 6 months. We're at the halfway point of the year. So let's say I do this for the next 6 months. Okay. So 6 months equals 6 trades at, let's say, 50 cents credit per trade. That can help me lower my Intel cost basis by $3, right? So even if Intel rips up to $27, $28, $29, $30, I know that I'm sacrificing some of that upside, but I do own the shares, and I can still use options to increase my profit potential and decrease my cost basis. Okay? So if I were to decrease my cost basis by $3 over the next 6 months, what happens if I eventually at the end of the year, I'm like, you know what, I've owned the shares, I've done what I could, I'm kind of exhausted, I'm doing this every month, it's whatever, you let it get called away. So let's say by end of year, okay, Intel is greater than 26, and we allow the shares to be called away. Okay, well, I go from a 22.41 break even to a 19.41 break even, and it's called away at 26. So for that same little boring trade that I had on that makes me $300, I can go from 26 minus 19.41, I make $659 on Intel. That return on risk, because I'm decreasing my cost base, is $659 divided by the 1941, that's my break even. So what is that? 26 minus 19.41. So 659. There we go. Oh, gosh darn it. 649? 659. There. Times 100. Sorry. Fat fingers there. 659. Divided by the 1941 cost basis, I'm making 34% return on risk. Because if it went to zero, I'm still risking 1941. If the original trade went to zero, I'm risking almost $2,300. So rather than making 13.4% return on risk by just letting it get called away, I'm making 33.9% by just owning the shares, adding covered calls, continuing to add covered calls, and just generate the income. Income every 30 days, every 30 days, every 30 days. It works. Sometimes it's not perfect. Sometimes you have to go, like I said, in the money, out of the money. You have to play around with those strikes, roll it a little bit differently. But for the most part, if you're just paying attention to, can I roll this based on time and strike price to give myself 50 cents credit, 50 cents credit? And you absolutely can. You can do that all the time. Today, for example, when I rolled Intel, I went out 3 weeks. Okay, not even a month. I went out 3 weeks and I got 84 cents credit. So between like 50 cents and a dollar credit, like that lowers my cost basis. But that's a big return difference. So what that looks like is if I own the shares here, and I let it get called away at 26. Okay, let's say it gets called away at 26. So this is me owning shares at 22.91. Okay, and this is $26. Okay, so this would be my standard price appreciation if I just let price get called away. There's my profit. If I use options over a 3, 4, 5, 6 month window and I just keep generating premium, okay, I'm going to decrease my cost basis. I'm going to put this in blue. I go from $22.91 down 50 cents. Oops. Let me change this to a line here. I go down 50 cents and then down another 50 cents and then down another 50 cents, down another 50 cents, down another 50 cents. We talked about doing this for 6 months, right? 1, 2, 3, 4, 5, 6 months. Well, I lower my cost basis now down to 19.91. Okay, now we talked about the initial 50 cents, so I have that 50 cents in here, so 19.41. Okay, I just want you to see what the difference is in if you do nothing, you just let it get called away, and congratulations, price went your way. The reason I do this so often is because price doesn't always go up. Price doesn't always go straight up. Price doesn't always go crazy bullish. And so if I can just take a little boring trade, use options, and go from a 13% return, this would be 13.4% right here. So here's 13.4 return on risk. Okay, there compared to a 33.9% return on risk. Now, obviously, if I ask anybody, what would you rather have? Most people would say I'd rather have the 33.9% return on risk. Okay. And then one person that's going to be skeptical or cynical is going to be like, well, what if it went up to $30? You just, cut your profits off because you're selling covered calls. Very true. That's the choice I'm willing to make by generating income on options, is I'm going to cap my upside. Sometimes capping your upside is great. I can still make more money. But if we have a stock that just becomes an absolute beast to the upside, I'm going to sacrifice some of that. But that's okay. Okay. I mean, case in point, this year, I bought shares of Tesla at $250. The thing went up to nearly $400. I could have sat on 15 grand in profit, but I ended up sacrificing some of that, and I'm now up. I took 7K and I flipped it again. 7K was profit, and then I did 9K in profit. I'm doing it again. And hopefully now this Tesla position I've been rolling a lot more is going to potentially pay me closer to $30,000. So I could have been up 15 grand and just taken profit and then said, that was a great trade. I timed it well. I got out of the trade. Or I can own the shares, use options, decrease my cost basis, increase my return on risk, and generate, $30,000 to $35,000 of income with just having 100 shares. It's kind of cool. Like literally today, I lowered my cost basis by over $700 on Tesla. I lowered my cost basis on one account for over $1,100 on Tesla. That's an increase to my bottom line. Okay. So, this is just, it's helpful. It's really just addition and subtraction. That's all it is. So somebody is asking, how do you keep track of this? I will show you. It's not crazy complicated. Here's Intel right here. Okay. So here's my spreadsheet. And all I do is I search. So, I've got all these trades from 2025. This is a tracker that carried over from last year too. So I've got a lot of trades in here. I'm down to core positions and roles. This is probably incorporating thousands of trades in here. But if I just search for my Intel, okay, all accounts, I bought the shares at 2104. added a collar trade, which means I bought a put, sold a call, and ended up getting a small credit for that. Break even is $20.96. I then added a covered call for the 7/3 expiration, which is this Thursday. That was a $22.50 sell call for 53 cents, which lowered my cost basis to $20.43. I rolled that call out to 8/1. So I rolled it out by basically the month, okay? And I rolled it up to $23. So I've increased my profit now by 50 cents, and I grabbed another 84 cents of credit on the trade, which in turn helps me make an extra $1.34. So $1.34 gets added to my bottom line. My cost basis is now $19.59. It gets called away. So 19.59 gets called away at 23 if I let it get called away. 341 on about 1,500 shares. I'm making over $5,000 in Intel. Now, for every time that I roll it, okay, every time that I roll it, if I get 50 cents on a roll with 1,100 or 1,500 shares, 11 cents on a roll, or 50 cents in a roll times 1,500 shares, I'm getting about $750 every 30 days that I roll my Intel calls. Does that make sense? So it might not make a huge difference right now, but every month it's $750. Okay. And if I do that on Intel, and I do that on Tesla, I do that on TLT, I do that on Pfizer, I do that on JD, I do that on Snap, I do that on stocks that I own. I don't have to own a bunch of stocks, but if I own 10 core positions and I'm selling trades like this, or I'm using trades like this, it adds up, right? Let's just say I did this on 10 core positions. I mean, that's an extra $7,500 every week, or I'm sorry, every month of just maintaining a core position, selling premium against it, and tracking it. So if I did that for every month, for the entire year, that adds to my bottom line. That seems ridiculously big, but it's very realistic based on the capital that I'm investing in the markets. I mean, very simple. Markets can go sideways, I can still make $90,000. Markets can go up, I can still make $90,000. Markets can go down, I can still generate the income, lowering my cost basis, and hopefully just stay out of the way where I maintain a profitable position and eventually just keep doing this. So, when do I stop this? I don't know. Honestly, it's like I like the premium so much, I might just keep doing it for a while until I feel like the market's taking a turn for the worse. Okay. So, Larry, does it answer your question as far as tracking? So here's one. I did Intel today. Tesla's another one. So Tesla. Here's one that I did today. This is so I flipped this one a couple of times. So Tesla, I did a ratio spread. It was actually a 1-1-1. I got assigned with a break even at 247. I quickly started adding a collar trade. I added put protection with the collar trade. I added a covered call. So you can just see like the cost basis, right? Break even 247.60, break even 244.60. I rolled it again, break even 242.05, rolled it again, break even 238, rolled it again. Okay, 239, rolled it again, 235, rolled it again, 232, rolled it again today, 230.42. And I also bumped up my strike to 260. So right now in Tesla, I have a break even of 230.42, get it called away at 260. That's on 500 shares. So if I let it get called away, I'm still going to make about $14,790 on Tesla. On top of the 7,000 that I cleared earlier, on top of the 9,000 I cleared earlier. I did the number. So 14,000, whatever it was, 14,000 plus 7,000 plus 9,000. So about 30 grand in Tesla. Okay. I do own shares of Tesla, but the price is clearly volatile. We're not going back to all-time highs. I don't know what's going on. Like today was something on, Tesla's down 5% because of its reliance on U.S. government subsidies. Okay. So what? I'm messing around with covered calls and I lower my cost basis by $700. Lower my cost basis by $1,100. It works. It's fine. Okay. Same thing on MicroStrategy. Same thing on some of these high flying premium stocks. Not every stock I want to own, right? But when I do, and it's very liquid and the premiums are really rich, I like to do this type of trade. I just wonder if there's any way. I mean, not really. The option stuff, Larry, and I have not found it. I have not found it. I asked Tasty. I asked Interactive Brokers. I asked Schwab. I asked Thinkorswim. I asked all these brokers, do you guys track the debits and credits on my behalf? And the answer is no. Not like this. right? They will track an individual trade. For today's trades, it's like I know exactly what happened today on SPX, right? All my trades today on SPX. Here's my trade setup for the day. So I had a daily profit play, put fly, call fly, 4 trades, 4 winners. Those are all closed out. I know exactly what I got in. It was 60 cents that I closed for 15 cents. It was 75 cents I closed for 25 cents. It was 70 cents that I closed for 35 cents, and it was 85 cents I closed for 45 cents. So that for the day, I know how that math works. I made money on those trades. Okay. But that's it. Like the only other way that I can go into Tasty would be I go in old school style. And this is for Larry again. You go into your history, and look at your trades, right? So if I go to, here's an example. I'll show you a bit of that Tesla campaign stuff. So if I go this account on Tesla over the last 120 days, okay, this shows my core position. Okay, so I own shares. It shows I'm down $22,800. If I get Tesla called away, okay, it gets called away at 260 times, 260 times 100. That's 26K. Okay, 26K, and I get the cost basis of 22,835. Okay, times this would be times 5 accounts. So that's the nearly $16,000 on this current position I'm in. I'm making about 16K in addition to the 7, in addition to the 9 that I made earlier. So I can go back and have, Tesla trades and I can do the historical, but honestly, like this to me is way more confusing than just writing it out as I do the trades. To me, this is simple. Like I put in the trade, I type it in my spreadsheet, and I know exactly what the break even is. If I add another transaction to it, I just track it. I add another transaction, I track it. This is a lot easier than going into my broker platform and trying to find exactly that transaction, what that strike was, what the credit. I just track it here. So when I open and close positions, I'm always tracking and updating my spreadsheet. Okay. So it's old school, but it works. I mean, honestly, it started off with like I'm doing this for all these client accounts, and it got pretty difficult here the last couple of years where I'm just like, adding more and more clients, and it was like I'm going to track for everyone. Well, once I'm starting to take like blanket trades and blanket strategies and copying everybody's trades, I just need my master account, and I can just go master account. So now it's just the one column, and I just look for my trades in here, and I just track everything, and then search for it. That way, when I look at my portfolio here, okay, if I want to see exactly what I did on Alcoa, or exactly what I did on Baidu, or exactly what I did on Go, or exactly what it doesn't, I can search in my spreadsheet, find the ticker, see exactly what the trade was, and go from there. So it's whatever. It's old school, but it works. I wish there was a better way to do it, but unfortunately, I've never seen a broker that can track it for you and do it. It's not that hard. It is like simple addition subtraction. It really isn't that hard, but it is the extra legwork of tracking your trades. But obviously, it's important because I want to know exactly what my trades are doing. Yeah. Okay. All right. We have 20 minutes left. We're trading at 62.01. I did have a 62. I had a 6,200 pin butterfly today. I will be a little annoyed if that would be a $500 winner, and I just let it. I took like $40 out of the trade. I did a broken wing call fly at 6,200, which is a little tight. I admit it was a little tight when this market was down here. Okay, when it was down here, I put in that trade for about $1. It got filled, so I took that trade out for 45 cents. So I grabbed 55 cents profit on the trade. That's fine. But obviously, if it's sticking to 6,200, that is my perfect little pin price that at the end of the day would be worth $500. I don't know if it's going to stay there. It could go up. It could go down. That's the risk I'm willing to take here in the next 20 minutes. But like I said, I closed out the trade already. I didn't want to worry about it. But it's one of those things where I'm like, I could have let it sit at 62 and made extra bonus trap today. That's the profit trap that's so hard to get, but it's so nice when you get it. All right, what else we got going on here? Nick's asking about Swiss pairs. Okay, well, Swiss was strong today. So was the Japanese yen. So Swiss pairs, you just hang on, man. I'm just waiting for decent turns. Honestly, I'm looking to see if gold pulls back to the 200 moving average, if we start to see a bigger shift in Swiss pairs, because they've been a strong basket for the last couple of years. Gold, I still think, has to have a pullback. And I think the dollar is also ready to make a turn. I think dollar is close to hitting some symmetry on a wave 3 swing. That's DXY. If we're starting to see some oversold conditions on the dollar, which we are, daily charts, weekly charts way oversold. A lot of divergence on the momentum oscillators, relative strength at 21 and 14. I talked about this a lot yesterday in session. And I think the dollar catches a bid. Dollar catches a bid, probably heads back into 100, maybe 101, maybe 102. From there, I could see the dollar selling off again and possibly going down to like 90, maybe lower. But until then, if the dollar starts to go up, I think that brings gold down. I think that helps the Swiss go lower. Swiss getting weaker also is a bit of this carry trade potential because the Swiss National Bank did cut rates to zero. You look at all the banks right now that have cut rates. The Swiss National Bank is sitting at 0%. So Switzerland 0%. So if you're holding Aussie Swiss long, which I am, I'm getting a 3.85% swap on that currency. CAD Swiss, I'm holding long, 2.75% swap on that currency. Euro, I'm getting a 2% swap on the currency. I mean, the Euro's cut rates like freaking crazy, like from 4+% down to 2%. So it's not great that central banks are cutting and the Fed is about to start cutting in September. However, Swiss is at zero. So there's still some yield out there and some positive swap, which I'm hanging on to. We'll see what happens with gold, Swiss, and the dollar. I think the dollar gets stronger. That probably takes a little bit away from the Swiss, and maybe this carry trade works. If we still have some risk on trading, Swiss gets weaker, dollar gets weaker, yen gets weaker. Carry assets like the Aussie, the New Zealand, the pound probably do pretty well. So what else in the let's see, Eurozone, we got New Zealand at 3, so it's 3.25% swap. Japanese yen, believe it or not, if you're short the Swiss yen, which I don't want to be short the Swiss yen, but if you're short the Swiss yen, you're actually getting a 0.5% swap. The UK is still sitting at 4.25. There's a 4.25% swap. And then the dollar, which is the weakest. Like, dollar has been super, super weak. One of the worst starts in 30 plus years, 40 plus years in the dollar. And the dollar still at a 4.25%, 4.5% yield. So if I'm holding dollar Swiss long, which is at some fresh lows, which I don't love, but if we are putting in some lows and divergence and the dollar catches a bid, I'm still getting positive swap by holding those positions. Okay. And that's what I'm doing. I'm holding positions. I'm holding for positive swap, and I'm looking for some price levels that make me some profit. Some of my net positions right now, honestly, on the Swiss pairs, if I could grab 50 pips net, 100 pips net on building up positions, I probably between Aussie Swiss, CAD Swiss, Euro Swiss, Pound Swiss, New Zealand Swiss, Dollar Swiss, I probably have 50 open positions, if not more. Okay. If I can grab a net profit on those positions, I will take it. 50 net pips, 100 net pips on 50, 60, 70 plus positions, whatever it is. The dollar amount is pretty solid. I mean, I could probably end up making close to, I don't know, $25,000 on some of my like little simple 100 pip winners, because I've got the position size up to several standard lots. So we'll see what it does. But I'm just going to hang in there, man. I mean, I look, the Forex market, the only thing I'd be nervous about, and I've never seen one, and I hate saying that because definitively you can never say never. Obviously, the markets can do things that always surprise us. But if we were to see a flash crash on the dollar, I've never seen that before. We've seen flash crashes on Swiss, flash crashes on yens, flash crashes on Aussies and pounds and euros. Never seen a flash crash on the dollar. Why would it be a flash crash in the dollar potentially in 2025? Because it has been one of the worst starts of the year, because it's a very crowded trade. You look at the dollar index right now. Okay, dollar index right now is a very crowded trade to the downside. So if people are forcing this sell trade on the dollar at a symmetry level, at a crazy trend over multiple months, I could see the dollar just turning and, kind of giving this trade a breather. And then we have repositioning up here where we shake out some of the sellers. We get a squeeze to the upside. Everyone starts chasing it again. And then real selling pressure comes right back in around past support becoming resistance. Maybe a little bit of a move up into some moving averages. And from there, the market rolls over and falls again. And it's a bigger resumption of the trend. But if the dollar continues to go lower, I don't see it going too much lower without having some type of technical bounce, just because it's Forex. I mean, Forex pairs oftentimes don't go in a straight line forever. We clearly see the market move in waves, and sometimes the technicals are really, really clean. So to me, oversold conditions with divergence means dollar likely would be popping to the upside to like 100, maybe back up to the 101 and change handle. And from there, I'd be looking to fade it. I'm not trying to call the dollar bottom. I'm really not. I'm just trying to not be stupid and sell into these lows. Okay. Apparently, Trump sent JP a list of central banks that have cut rates. President continues to find. yeah, the point is, it always works like that though. The Fed is always the first to talk and the last to act. Truly. Like the Fed, when they talked about raising rates, they were one of the last central banks to start raising rates. When they talked about cutting rates, they were the last central bank to start cutting rates. They get a lot of mileage over talking through their plans. It's the biggest, baddest bank in the land. So, other central banks are more active. I mean, you got the Eurozone. I think your ECB has cut like 6 or 7 times, maybe 6 or 8 times in the last couple of years. They were up to like 4.25%, 4.5%. They were right alongside us. We were at 5+%, right? We cut by 100 basis points, and the Eurozone went from like 4 and change down to 2. They've cut like 8 times. Aussie's cut multiple times. New Zealand's cut multiple times. Pound's cut a couple of times. They've kind of hung in there with a higher rate, with a pause. But yeah, every central bank has been cutting. The BOJ is not. They raised rates from negative 0.1 to 0 to 0.25 to 0.5. The Swiss was 0.75, now down to 0. So they've cut a decent amount. But the dollar's like the last one to see a cut. It's going to be September, October, December from the Fed Watch tool. But the Fed is always that bank. So Trump, trolling Fed or trolling Powell and saying this, it's always the same. The Fed is an independent body. Some are going to argue, look, nobody's going to be happy with the Fed. If something breaks, it's the Fed's fault. If something works, it's never the Fed's credit. And certainly with this administration, like, nothing's going to be Trump's fault. So if something does break, I mean, realistically, Trump and the trade war tried to break the market in a way. That's why the market flinched. That's why the basis trade erupted. That's why we had a crazy 60 to 80 basis points move in yields. That's why we pivoted so hard from this austerity measure in Doge into grow at all costs. And now we're begging for the Fed to cut rates, and we're going to run this economy super, super hot. We're going to somehow squeeze in and add maybe another $2.5 trillion to the deficits. It's past the Senate. Now we're going back to the House. The House, it was a 215 to 214 pass. I don't know if there is going to be a fight for this bill. I mean, Elon Musk is being vocal about what's in it. They've removed some of the crazy taxes. Like, there were like big taxes on solar and wind, and that's been removed. I don't know. Like, I'm sure for 960 pages in a tax bill, there's probably crap that you can't believe is in there. And do you think an 80-year-old is going to read that in a month? Probably not. So anyway, we'll see. It's like, if they pass it, okay, so it passed the House initially by 215 to 214. It passed the Senate. Now it's going back to the House. So what type of reconciliation? I don't know. Maybe it's fought. Maybe it's contended. If that's the case, how's the market react to it? We'll find out. Okay. So why is the dollar so weak with the largest economy and highest rates in the world? Well, because we had the highest currency and we got the best stock market. Now, if you want to see the stock market run higher, you're talking about, adding deficits. You're talking about, this trade war, which is supposed to balance the trade deficits a little bit better. It's just the dollar's weaker because we're trying to play nice with the world in trade. And also because it's not a risk-off environment, the dollar's getting weaker because it's been a risk-on environment. And it's almost been accelerated risk-on because it's also showing like a lot of people are kind of moving away from the dollar a little bit, or moving away from bonds. They're still liquid. They're still not going anywhere. They're still auctions, but the bond auctions are definitely more short-term focused, not long-term focused for right now. But the bonds have stabilized. If you look at TLT, since May, we've stabilized quite a bit. Okay, so we've got the bond market off the lows by about 6%. And we have the US 10-year yields from these recent highs down about 8.5%. So, I mean, TLT goes up, yields go down. That's a fair correlation. That's what it should do. My question, of course, is later this year when the Fed starts cutting, are we going to have this reaction like we had in 2024? Yields go up as the Fed cuts rates. Okay, what we hopefully have happened is, if the Fed's going to cut by 0.75, it'd be nice to see rates, or yields rather, go down by 0.75. It'd be nice to see that. My concern is that yields go up. That's what I'm actually worried about in 2025, is we cut rates and, I mean, I don't think Powell cares. I think all the vocal trolling that Trump is doing against Powell, I don't think Powell really cares. He's certainly not going to be the Fed chair next year. So if he can just hold the line, his legacy is don't let inflation spike to a second wave that's going to get way worse. How do you do that? You just push back in the narrative. We push back, we push back, we push back. Yes, we cut September. Yes, we cut maybe. But if we see a big spike in inflation, I don't think the Fed's going to cut. If we see inflation tick up towards core, especially if we see core CPI back up towards the high twos or even over 3% again, if we're trending in the wrong direction. So here is, here's the core CPI. Here's CPI headline. Okay. So if we start trending up again to 2.6, 2.7, 2.8, in fact, what I read for 2 weeks from now, the CPI print, the Atlanta Fed has a 2.6% inflation reading. 2.6%. If you go to Trueflation, has this been trending up? Okay. From the lows at 1.22 to the recent highs, we have been trending higher. This is up over 1.04%. Now, it's not perfect math like this, highs at 3 down to 1.22. We clearly didn't see like a 2% drop in CPI, but percentage wise, I mean, it's down a decent amount. Do we see this up a decent amount? So I look at this trend higher, okay, translating into potentially this trend higher. So I don't think we're coming anywhere near 2%. I think we're going to go maybe up to 2.5, 2.6. The Fed looks at this. We are literally no better off than where we started in summer of 2023. That's not good, right? This is why the Fed has been reluctant to cut, because inflation, I mean, look, we all know how bad it's going to get. How bad would it get if inflation goes greater than 3%? If our headline reading is greater than 3%, you know as well as I do, this market is all of a sudden going to put inflation front center. What's the Fed going to do? I mean, look, a trade war is inflationary. A tax bill is inflationary. Powell said this repeatedly, like we don't know what the effects are of the trade war. We don't know what the effects are of tariffs. But if it's going to trend higher, nobody's going to be happy if we've made little to no headway on inflation since 2023, right? We're coming into almost 2 years of this where it's been up to 3.7, down to 2.3, 2.4, back up to 3%, back down again. If we're going back up, it's like we're not winning. We're not winning this war on like persistent inflation that is breaking the bank and stretching the consumer, and to the point of breaking the consumer. That's where we would kind of roll over into a softer economy. That's your stagflation worry, right? People are stretched. People are overextended. Life is more expensive. Producers are, absorbing some of the tariff costs right now, but let's say they pass those costs on to consumers. Well, tell me something that's cheaper for the last 5 years. What's one thing in your life that's cheaper? That's like a staple for most people. Okay. Healthcare, childcare, contractors, home improvement, groceries, anything, like name it. I don't see anything in my life that's cheaper right now. Nothing. You probably don't either, right? So if we start to see this going up, what does that mean? It's just telling everyone like stuff isn't getting cheaper. Get ready for more higher prices. Get ready for more persistent inflation. It is exhausting. These last 4 to 5 years for most people has been really stressful day to day just to get by in the essentials. The best part has been, if you've been an investor, the market's been up. And we've had a blow off top since we broke the highs in 2024. We had a melt up year in 2023 and 2024. We're still at all-time highs right now. It's not a bad thing. But I just don't know if there's something that's brewing in this market to make it break, to make it roll over. Yes, no, maybe so. So look, we can run the market hot. If you think about this for a second, think about the movie Big Short. It's one of my favorite movies. If you think about the pain and annoyance that Michael Burry went through, so this would be Christian Bale's character. Then you got Steve Carell in that office, that little like hedge fund office. You got the two guys at like Brownstone that were like the little garage traders. I mean, these guys saw a trade that was mathematically correct, and they were furious for years, literally watching the trades go against them, the positions go against them, the premiums out like off the charts, just, like they were just hemorrhaging in thinking of dumping positions. But ultimately it paid out. And it took, 2+ years, but when it did, it paid out, 10-fold, 20-fold, 30-fold, and it changed everything. But brink of financial Armageddon. I hope we don't go back to that. But I'm just saying, like, the markets can do silly things. The markets could melt up to highs again, and we could be at 63, 64, 6,500 S&P before we have like a 30, 40% correction that really takes the market by storm. And then we spend years going sideways. It's like you never know what this market's going to do. People are trying to rationalize something that can be completely irrational. So this is why risk management is the most important thing. Yep. Kyle says no one would seriously buy euros over dollar. I know that's the point is, and this is the silly saying that's been going on for a while. The dollar is the cleanest dirty shirt in the laundry. I've heard that saying so many times the last couple of years. Look, the Eurozone has been cutting rates. They have, a lot of economies there that are on the brink of I don't know about bankruptcy, but I would say recession. It's just not a replacement. I mean, China, I don't think the world wants to get behind China right now. Nobody really trusts the metrics and the numbers. But I think people would be okay without just printing money to oblivion, without adding to a ticking time bomb debt cycle. Maybe trying to find some alternatives like, commodities, gold, silver. Bitcoin's new, but Bitcoin's been appreciating like crazy for the last 10 plus years. So, I mean, if you have an asset that's appreciating, look at something like the cost of a house in 2020 compared to what it is now when you take it and compare it to gold. Gold prices have gone up, house prices have gone up, but because the pace of gold has outperformed, things are actually cheaper in terms of gold. Bitcoin, if you own Bitcoin and you own Bitcoin now, over that 5-year window, that price has gone up and appreciated. Prices are cheaper in terms of Bitcoin, right? It takes less Bitcoin to own a house now. It takes less Bitcoin to own a car now. Unfortunately, like unless you're invested with the debasement of our currencies, that's the only reason the stock market's gone up. You look at the Nasdaq, the S&P going in a straight line to the upside of this, clip of 20% a year, 20% a year. Look at the debasement. Look at the money supply. It's the same thing. That's the only reason the stock market goes up. It's just helping people stay break even. The real growth and appreciation is coming from other assets. But if you're not participating, you are definitely falling behind. So anybody that's in cash, unfortunately, they're falling behind. And that's the hard part is you think it's risk free, but I mean the hidden theft, the hidden tax is inflation and debasing the currency and loss of purchasing power. It's tough. So anyway, so I mean nobody's going to just side with the Eurozone. They're not going to side with China. It's like the U.S. the U.S. is an integral part to the global economy. So this whole point of like death of the dollar and it's going down and the dollar is needed. It's like it has been a long time reserve currency. It still has safe haven status, whether you like it or not. Like if the dollar goes down, a lot of things are going with it. If the U.S. economy goes down, a lot of things are going with it. And I think that's the reality that we saw back in April. If you want to see what systemic looked like, look at our economy. Like look at our stock market and look what the entire world did, right? You go to SPX in April when this is all taking place. Okay. So let's go from March 26th. Okay. March 26th. Oh my gosh. This thing's pinned right at freaking 6,200. What a piece of crap. Let me go. I'm just for fun. SPX, this trade for 45 cents is now trading for $3.60. Son of a biscuit. So if I was in that final minutes, anybody watching Daily Profit, we talked about this. There's my pin price for an extra $300. Now, if I let it cash settle, this is really like a $400 profit trap right now. 6,200. We got 1 minute before the close. Let's see what price does in these last couple minutes. 61.98, 42. This is still like a $300 profit trap. We got final minutes here. 97. Still about a $300 profit trap. I'll do the exact math when I can find a close price. You can see the mid price trading around 350. It's like this is a max profit of $5. Like there you go. So 97.30, that would be a extra bonus of about 200 and whatever. I mean, this is jumping around a little bit, but I mean, pulled in 85 cents, closed it out for a bonus of 360. You make $400 some on the trade. That's pretty good. Okay, looking like it's kind of cash settling here around 6198. That'd be a $300 profit trap on top of the 85 cents. So it pinned today right at that 6,200 level. Okay, all right. I was just going to say in these last couple minutes here, look at March 26th. I'm going to write this down. March 26th to basically April 7. because that's when the bottom was. Okay, so our market's down about 16.5% in the S&P over the course of just a couple of weeks. So 16%. Now take that to the DAX. Okay, one of the best performing indexes this year is non-US. Go to March 26th. You're down 21%. Systemic. Look at the HSI for China, the Hang Seng. Okay, March 26th, you're over in this area. March 26th, you're down 20%. Go to, let's see, what else? FTSE. UK stock. Okay, March 26th, somewhere in here, you're down 13.6%. Go to Brazil, EWZ. Okay, this one surprisingly was already so bad that it got a little bit better. But here's March 19th, we're down about 15%, and then we jump pretty hard. What other economies can I look at? That was Brazil, Latin America, kind of the same thing. We did China, we did Eurozone, we did the UK. You can look at India. Okay, so India. So you can look at INDA for just this is the MSCI. Okay, you got your Nifty 50 right here, but here's your India trade. So here's again March down there, down about 7%. Okay, so you can just see the resiliency of like everything went down with it. So when we were falling in the US, everything went down with us. The difference was the pop to the upside was the kind of quick non-US value play that was, I mean, everything was so beat up for a while that it's like, yeah, easy money is just going into where things are dirt cheap. Go to the Eurozone where it's a 12 times multiple instead of going to the US market where it's a 22, 23 times multiple. Okay, if something goes basically right in the Eurozone, you can make some money. So it's been good. But I think that the US has stabilized enough so that money's flowing back into the US. US tech is still a major powerhouse. US resiliency is still alive and well, and that's a good thing. So anyway, I don't know. I mean, there's clearly flows. This year has been an interesting market mix where if you traded non-US, you did okay. You trade US, you survived, and now we're starting to see some pretty good gains to the upside. We had like a almost 30% rally off the April 7 lows. My question is, do we sustain it? Do we continue it? Maybe. Okay. Do you trade CMG? CMG as in Chipotle? I did after they split. Yeah, I mean, I did some ratio spreads down here. I sold a bunch of puts on Chipotle. I think I might have already taken profit on them. CMG, check my positions here. I did a bunch of naked puts. I don't have it any longer. So yeah, I took profit. So I stacked up some puts here, 40, 39, 37, 36. I did 275 credit. I did this on like 10 accounts. So yeah, I was willing to own the shares. But if I had shares, I was going to hold it to a 69 price target, which is back up to the highs. I actually don't mind some Chipotle, CMG. If I do ratio spread, I might actually take this trade too. So we got some insiders selling. It's pretty high price to earnings, but I don't love that. I mean, it's 50 some dollars, fair value at 40. But the nice thing is if I could do something where it's like, all right, well, if it says fair value 40, can I own it at 40? I think this is a great spot to be owning some Chipotle. You know, I mean, who doesn't like a little Chipotle action for lunch? Unless you're annoyed with like $3 avocado toppers. But I still like it. So if I were to take a trade on this, I probably would set up a trade where this is done. This is out for profit already. Could I position myself where I could own the shares at $40? And the answer is probably yes. So CMG, go out to the end of the year. Let's see what it looks like into December, January, and then do a ratio spread. Okay, I'm probably not going to make a ton of profit on it, but if I did like a 42 by 41, and I'm willing to own a couple hundred shares, okay, so I get 77 cents credit, and I own the shares at $40 and change. So if I get assigned at 41 minus 77 cents minus the dollar profit trap, I own it at 39.23. So I can own shares of Chipotle down here around $39. and that's a bounce off this 5-period yearly average. And maybe this is a high, low, lower, high, lower. I mean, just a correction, something like this, right? If it comes back down, honestly, my favorite trade would be if we go up and then back down, would be to look at a ratio spread down here where the premiums are a little bit higher. But I wouldn't mind getting in position for it where I could own it if I took the shares. I think a quick like repair. What's a 30-day option on this thing? 30 days out, an at the money call is going to pay somewhere between like $1.50 to $2.50. So if I own the shares at 39, I go out 30 days, I own it at 37. I go out another 30 days, I own it at 36 or 35. I keep doing that, and I do the same thing. That brings us to full circle with today's discussion, which is doing some basic math on your portfolio. If I started the ownership process at $39, I could lower the cost basis to 37, 36, 35, 34, 33, 32. It's going to take time to do that, but all it's doing is increasing my profit potential when I'm eventually letting the stock get called away or just generating income. So I do like I do like the stock. I'm not sure why it's expected to be lower. I mean, this stock for a long time was like crazy good, right? Before they did like the big 50-to-1 split, this stock was like unaffordable. I was not interested in trading this at all when it was like a $1,200 stock. So yeah, now it's cheaper and it's still maintaining structure. I think there's decent premium. If I could own it at 40, I think it's a good trade. So let me see, how good is it? I'm a little bit more concerned in 2026, honestly. If we don't pull back in 2025, I'm way more concerned going into 2026. We have some type of correction. So, I mean, how far out do I go? Here would be, January. If I went to like summer, I just do a leap, right? A summer leap. So I go out to June of next year. Let me look at this. If I do a ratio spread, I'm still willing to own Chipotle at $40. I can do a 42 by 40. It's crazy. I'm only getting 65 cents for going that much further out. If I do this, I go, I'd own it at 40 minus the dollar. I still own it at $39. This isn't a bad way to start. I get $100 income, but I'm out way further, So, but it's doable. I don't know. I'll take a look at it. I think it's an income trade. I just don't know if I need to go out to June of 2026 when I can go out to maybe December, January. So anyway, I'll put a pin in that. We'll talk about that more tomorrow. Okay. All right, everybody. I'll let you go for today. Appreciate you being here. I do have a couple things just to share before we go. Just added this in Telegram, added this note. I've been doing some webinars this week on daily profit play. I did post a video today in class. Here's my profit play Telegram. I posted this video. It's 32 minutes long. Anybody that's in my daily profit play class, please watch it. Okay. We have some new members that have come in. We've modified the strategies a little bit to make sure that we have a plan of attack every single day for an up, down, sideways move. I never know what the market's going to do. Neither do you. In a 0-day environment, it's anything goes. So I'm doing the best that I possibly can to win, and we are doing pretty well. I mean, we've got a nice little hot streak right now. Outside of 2 very small losses, we are in a win streak of, last time I took a notable loss was 527. So over a month ago. So 894 to 934. 934 minus 894. I've got 40 trades and I have 2 small losses. So we are 38 for 40. We're at a 95% win rate of daily profit play. We are grinding our faces off, making some money. So how are we doing it? It's in this video for my daily profit play members. If you'd like to learn more about it, you want to see, check it out, right? There's if you want to get a webinar on it, you want to, talk to our team, support at prosperitypub.com, that's fine. But it's working. When we're talking about all this uncertainty, make some daily income. Trade to win the day. If you can win the day, you're going to make some money. Who cares what Trump says? Who cares what the Fed's going to do? Whether the market's up, down, sideways, you're still making money. That's a good thing. So I don't know. If you're interested, check it out. Today's session, just want to start this off. Tomorrow at 11 a.m. Eastern time, I'll be in a profit panel session. It'll be myself and Alex Reed and Kane Shea. It's going to be a lot of fun. I love when we can all get together and kind of do some roundtable stuff. So it'll be tomorrow at 11 a.m. I'll post that also in Telegram. There'll be some links for it. Just come in. It's just great knowledge, good sharing, good collaboration, and we'll talk some shop. Okay. All right. Good stuff. I will see you all tomorrow. Have a great day. Thanks. Bye.